Assalamu alaikum listeners, welcome back. I'm going to discuss chapter number 12 of Introduction to Financial Accounting. It is about accounting for partnership. So let's resume our journey towards the financial accounting. There are three learning objectives for this chapter. We'll be talking about how do we record or how do we account for formation of partnership. Means when the business is started, how do we record the formation journal entries? Then, second learning objective is that how we are going to distribute or record the net income or the net losses of the partnership. Means when we prepare the income statement or the financial statements at the end of the year for partnership, so how we are going to distribute the losses or the gain or the profits between the partners. And then the third learning objective is about the liquidation of the partnership. In this recording, I'm going to cover the first two learning objectives, and then the second part of chapter 12 recording will include learning objective number 3. Let's proceed towards our first learning objective, in which we will be talking about the basic features or the characteristics of partnership, followed by the formation journal entries of the partnership. So partnership is basically it's a mutual understanding, or you can say it's a business which is formed from the mutual understanding between two or more parties. It's an association of two or more people or persons. They form a business in which they carry on the business as co-owners, both of them, or who as many numbers are there, they all are the owners of the business, and of course businesses are for the profit sake. Usually this form of business organization is smaller than the company, so small type of retail businesses or some grocery stores or some small departmental stores or some service organizations or some small form of companies are the type which are covered under the partnership structure. Also, some professionals like accountants, lawyers, or doctors, they also create their partnerships. We'll be talking about these different types of businesses and the different categories of partnership in a while. Let's talk about the basic characteristics of a journal partnership. When I say journal, journal means there is no, a specific features, a normal partnership which is made by two or more people. So, number one, it is an association of individuals and it's a legal entity. Legal means it's recognized by the law, it's legally allowed to create such business. And it's an accounting entity, it records its business transactions. Uh, in US, the net income is not taxed as a separate entity. Just like companies, they pay dual tax. Dual tax means that the companies pays the tax as an artificial person, and its owners also pays the tax. But in case of partnership, just like sole proprietorship, it the firm pays the tax. Owners are not taxed separately. Mutual agency. This is the second characteristics of the partnership. Mutual means together, combined. So mutual agency means that it's binding or it's an agreement between all the partners that they will be responsible or they will be binding for each other's act as long as the act is or the action is appropriate for the partnership. It's a proper action. It was taken in the good faith. So, act of any partner is binding on all other partners. Let's suppose if one partner brings a new client, he wants to do the business with that client, and he knows that the client is good for the business, then other partners will be accepting it. They are not going to say that no. Or in other words, if one partner does a deal, others are going to accept that if the deal is in the best interest of the business. Followed by some more characteristics of the partnership. Limited life. Limited life is for the partnership contract. I'm not talking about the business. Business will keep on working, but the contract, which is partnership agreement, that will come to an end. When it will come to an end? Whenever a partner he wants to leave the partnership, he wants to withdraw from the partnership, he doesn't want to continue, then the old partnership contract will come to an end and a new partnership contract will be made. Also, if a new partner joins the partnership firm, then again the old agreement or old contract of partnership will come to an end and a new agreement will be signed. So here they clearly mention that dissolution of partnership does not mean here that the business will come to an end. It means that the contract will come to an end, a new contract will be made. The most important feature for the journal partnership is it has unlimited liability. Unlimited liability means each and every partner in the business is liable up to the business debts, or you can say he's personally liable to pay back the partnership liabilities. His personal property is also going to be used if his business investments are not enough to pay the liabilities. So each partner is personally and individually liable for all the partnership liabilities. The last feature is co-ownership of property. Co-ownership means they own the property of the business together. All the partners, they have a claim on the assets of the business. No, they cannot, once they bring the assets to the business, they cannot say because I brought this building, so this is mine. No, once it's added to the partnership business, now all the partners, they have claim on it. So all the net income or losses, they are shared equally by the partners. But if they are not, then in that case, it should be clearly written in the agreement that how the profit and loss will be shared. If it is not mentioned in the agreement, then everybody is going to share equally. Either it is a profit or it is a loss. So net income and losses, generally, they are going to be shared equally. So for the journal partnership point of view, following are the features or characteristics of the partnership except. So they say co-ownership of the property. We talked about five characteristics. We said it's an association of individuals. We said it's mutual agency. We said it has limited life. It has unlimited liability. And fifth one is co-ownership of property. So, from the journal partnership point of view, they say all of them are the characteristics of the partnership except, so let's see, co-ownership of property, yes, we said that. Mutual agency, yes. Limited life, yes. Limited liability, no. For a journal partnership, liability of the owners is not limited, it's unlimited. So that's why fourth D is the answer. Let's proceed towards different types of partnership organizations, and we will be talking about their characteristics. So, under the partnership, till now, whatever we discussed, that was for the basic type of partnership, or you can say the journal partnership. Now, let's talk about the special forms of business organization which are made because of the negative factor, which is unlimited liability in the journal partnership. So in order to avoid the unlimited liability, special forms of partnerships are made. We are going to discuss three of them. First is the limited partnership. Second one is limited liability partnership, which is also known as LLP. And third one is limited liability company. Here they gave us a hint. The hint says that LLP, which is the second type, limited liability partnership, have limited liability for all the partners. There's no journal partner. Now, what does it mean? You will understand it when we will discuss the first type of the partnership, special partnership, which is the limited partnership. But before that, let's quickly go through the concept of regular partnership or the journal partnership which we discussed few minutes back. So what are the advantages of journal partnership? Major advantages. It's simple and it's inexpensive to create and operate. And the disadvantage is all the partners or the owners, they are personally liable for the business. That means their liability is unlimited. So all the partners in the regular partnership are known as journal partners because they share the journal features of partnership. The first specialized partnership organization is known as limited partnership. We call it as LTD or LP. A limited partnership Most of the partners, they have limited liability, but there should be at least one journal partner. What are the journal partners? See, we just discussed that the journal partners, they are personally liable to pay the debts of the business, so their liability is unlimited. If you have limited partnership, in that case, there will be as many limited partners as the partnership wants, but at least one journal partner should be there. So what are the major advantages of limited partnership? So limited partners, they have limited liability. Uh, their liability is limited up to some percentage which they share. But there is one condition. The condition is that they are not allowed to participate in the management. Why? Because if they will participate in the management and they will take a wrong decision, so they will only share limited loss because of that wrong decision, and the journal partner will suffer ultimately. That's why limited partner and limited partnership are not allowed to participate in the management. Journal partners are the one who handles everything because they bear the unlimited liability. So journal partners, they can raise the cash without involving outside investors in management of the business. They raise the cash, they deal with all the functions of the limited partnership. There are some disadvantages as well for the limited partnership. Number one, the foremost, that is, journal partner has unlimited liability. He's personally liable for the business debt. Because it's a special type of partnership, it's also expensive to create as compared to the regular partnership. Which type of companies usually use limited partnership? So real estate is the one category of limited partnership. Okay, so the second category of specialized partnership is known as limited liability partnership. Um, this type of organization is usually made by some professions, or you can say people who are in specialized profession, like auditors, like law firms, like medicine, or accountants, or you can say doctors. So they can make their own partnership. Um, the difference between limited liability partnership and the limited partnership, which we discussed in the previous page, the difference is in the first category, which was limited partnership, one journal partner is must. But in the limited liability partnership, there is no need for journal partner. Owners or the partners, everyone, they are not responsible for the malpractices or the bad practices or deficient practices of other partners. Everybody is responsible for their own act. They are not responsible for the other partner's wrong decisions. So the common example could be that if there is an organization or a partnership made by five dentists, and one of the dentists, he treats his client, you can say patient, not correctly. He did some surgery for the dental purpose, and it went wrong. So other doctors are not responsible for his act. So everybody is responsible for his own practices. So this is the advantage because you are not being charged for the wrong deeds of your colleagues. What are the disadvantages? Disadvantages is each partner remains liable for his acts, whatever obligation he owns to the business creditors or lenders or landlords or whatever customers he's dealing with, he remains personally liable to them. And usually this type of partnership is for specialized professions, so it's not common like a limited partnership. So this was the second category. The third category is known as limited liability company, LLC. Limited liability company is also known as hybrid nature of business organization. Why it is hybrid? Hybrid means something which contains the characteristics of multiple things. So limited liability company contains the characteristics of partnership plus company. that's why it is known as hybrid form of, you can say, business organization. So, such type of organization usually have limited life. It's not for longer period of time. And owners, they have limited personal liability for the business debt. But here, one important feature is that when we talked about first category of specialized, that was limited partnership, we said those partners who has limited liability, they will not participate in the management. But in limited liability company, they do participate in the management, and they are responsible for their liabilities up to some extent. um, Major disadvantage is it's most expensive as compared to all other categories of partnership. So these are three different specialized types of partnership, for which we have discussed their advantages and disadvantages. So here are the journal advantages and disadvantages of partnership. When I say journal, I'm talking about a normal partnership. So the advantage is when many people or more than one person, they work together for a business. Everybody brings their own skills. So the more resources and more skills are available as compared to the sole proprietorship. It's easy to form a journal partnership. The regulations on the partnership are less as compared to the corporations or companies. And also, decision making is easy in case of partnership as compared to the companies, because the partners are not in thousands, they are few. So it's easy to agree on a particular decision. Disadvantages for journal partnership is that mutual agency, limited life, and unlimited liability. We already discussed about it. Now, when I was talking about limited life, I said that limited life means that the partnership um, contract has limited life, not the business. When I say partnership contract, then we talked about it that if a new partner is admitted to the business, the old contract will end. So contract life is limited. A new contract will be formulated. If a partner is going to leave the business or he is going to withdraw from the business, again, the partnership contract will come to an end and a new contract will be formulated. So let's talk about what this does this partnership contract or partnership agreement means. So here comes the partnership agreement. So partnership agreement is a deed or it's a document which is signed by all the partners who are the members or who are the owners of the business, and it should specify relationship among the partners clearly, name and how much everybody has contributed in form of capital, who bring what for the partnership, what are the rights and duties of the partners, how they are going to share the profits and losses. Then if they want to withdraw some assets, what is the provision for assets withdrawal. Then if there is a dispute regarding some matters, how the procedures are going to be to handle that dispute. Then if a partner is going to be leave he's going to leave the partnership or he's going to withdraw from the partnership, or if a partner is going to join the partnership, then what are the procedures regarding that. And if a partner he passed away or he's dead, then what are the rights and duties of remaining partners in the case of death. So these are the points, or you can say clauses, which we add in the partnership agreement, and they clearly mention that how the procedures would be. Now let's move towards the accounting treatment for the partnership formation. So I have an example over here. Adolphi and Tishia combines their proprietorships. Proprietorships means sole proprietorship to start a partnership named US Software. So Adolphi and Tishia, they were having their own independent businesses which were sole proprietorship. So they combined their businesses and they made a new partnership business, that is US Softwares. Rolfiencia has the following assets prior to the formation of the partnership. So some assets they are discussing for both of them, and before the formation. So they brought them to the partnership. Now, in the table below, you can see that we have book values and we also have the fair values. Book values means that what are the values for the assets in the books of, or you can say in the balance sheet of both the owners. And the fair value means what is their current possible value, which you can get by selling these assets in the market, or you can say their current value in the market. So let's start from the cash. In balance sheet of Aerolfi, there was 8,000 cash, and of course, the fair value for this 8,000 is going to be 8,000 because cash is cash. TCR was having $9,000 in his balance sheet as cash, and the fair value is also 9,000 for it. Equipment. Aerolfi has an equipment of 5,000. TCR doesn't have any. And Aerolfi has accumulated depreciation of this equipment 2,000. So if you net this out, the book value for this equipment is 5,000 minus 2,000, that is 3,000. But when they check its fair value, the fair value becomes 4,000. Accounts receivable were found in the books of TCR, they were 4,000. But he has also recorded allowances for doubtful account, means he was doubtful that he will not be able to collect 700 out of these 4,000. Now, when you revalue them according to the fair value, accounts receivable were still 4,000, but uncollectible allowance was not 700, it increased to 1,000 according to the fair value. Now, remember the rule. When assets are brought to the partnership, we record them at their fair value, not the book value. So in order to record the journal entry, we're going to ignore the book values and we're going to record these assets, cash, equipment, receivable, all of them according to the fair values. So let's record the journal entries for the ownership of Aerolfi or capital of Aerolfi and TCR. But before that, let me just quickly summarize. So if I'm going to record for Aerolfi, the fair value of Aerolfi cash, he brought 8,000 and equipment is 4,000. There is nothing for accumulated depreciation because they already netted off. So two assets he brought, cash and equipment. So let's record the journal entry. He brought cash for 8,000 and he brought equipment for 4,000. So this together is his capital. 8,000 plus 4,000 equals to 12,000. This is Aerolfi's capital. Now let's talk about the second owner, which is TCR. He brought cash 9,000. He brought accounts receivable 4,000, but there is allowances for doubtful account of 1,000. So we are going to record them, but before recording, let me just revise this concept with you that allowances for doubtful account is a contra asset account. When asset has a normal balance of debit, allowances for doubtful account is going to have a normal balance of credit, just like accumulated depreciation. Okay, so when you're going to record them in the journal entry, accounts receivable will get debit, but allowances will get credit. So let's record this journal entry. Cash, TCR brought, that's 9,000. Accounts receivable are 4,000. He also have allowances for doubtful account 1,000. So when you net them off, 9,000 plus 4,000 is 13,000. We have already 1,000 on the credit side, so remaining is 12,000. So his capital is 12,000. So I just gave you the rule that how do you record the non-current as non-cash assets. So we record them at their fair value. Moving on towards the second learning objective, that is how to account for net income and net losses of the partnership. In other words, how to divide the net income or net loss among the partners. So partners, they equally share the net income or net loss unless it is clearly specified in the partnership contract. So what we are going to do, we are going to close all the revenues and expenses accounts to income summary so that we know do we have a net income or net loss. And then we're going to distribute this net income or net loss to the partners. So income summary account, we will close it and we are going to close it to each partner's capital account because we will distribute profit or loss to the partners. Also, if there are some drawings done by partners, we're going to close these drawing accounts as well. Let's talk about what are the possibilities to distribute the income. So we have some income ratios. It's clearly mentioned in the partnership agreement that how you are going to distribute the business income or losses among the partners. So we could have fixed ratios. Fixed ratios means that, for example, you can say 60% Mr. A will share, 40% Mr. B will share if there are two owners. So we have fixed ratios, fixed percentages. Or some partnership organizations, they have ratios based on capital balances. Who have as much capital balance, he is going to get that much profit share. So let's suppose if Mr. A has capital balance of 10,000 and Mr. B has capital balance of 20,000. So the profit will be distributed among A and B based on this capital balance ratio. So one out of three pieces will be taken by Mr. A and remaining two will be taken by Mr. B. Sometimes partners, because they work for the business, so they can also claim for the salaries for their working. So if this is the case, number one, it should be clearly mentioned in the partnership agreement. So we pay salaries to the partners. Now, because partners are owners, so their salaries could not be expense. Their salaries should be taken out of the net income. Once you are done with the income statement preparation, then you will take out their salaries from the profit. Next is interest on partners' capital balances and the remainder on a fixed ratio. They say you can also distribute the income between the partners. Firstly, give interest to them if it is stated in the partnership agreement. Sometimes partners, they want that whatever capital they have contributed to the business, they want any trust on it. If this is so, so first pay the interest out of the profit, then remaining you can distribute to the partners based on their fixed ratios. And the last one is maybe there are salaries to be paid to the partners, maybe there is interest on their capital balances to be paid to the partners, and then remaining money will be distributed according to the ratios which they have. Any of these possibilities could be there. So whatever is the condition, handle it accordingly. So let's start with one example. Sarah King and Ray Lee are co-partners in the Kingsley Company. The partnership agreement provides, so agreement clearly says that salary allowance of $8,400 to King and $6,000 to Lee. So they say that both of the owners, they charge salary to the partnership. They want a salary. So how you're going to give them salary? Salary for the partners is not going to be expense. It will be paid out of the net profit. So firstly, you have to pay to both of them. Second, point number two, interest allowance of 10% on capital balances. So whatever is their capital balance, take 10% interest and pay it to them. Fixed capital balance. We could have opening capital balance, we could have average capital balance during the year, we could have ending capital balance. So for this case, they say whatever was the beginning capital balance at the start of the year, take that and give 10% interest to both of the partners. And then whatever profit will be left over, divide it equally. So let's read some more details. Capital balances at the start, which is January 1st, for King was $28,000 and Lee was having a capital balance of 24,000 at the start of the year. Also, they are telling us the company partnership net income is $22,000. So what we are supposed to do, we are supposed to distribute this net income among the both partners, but don't forget, you have to pay them salary allowances, you have to pay them interest allowances, and then the remaining profit is going to be distributed equally. So we have to prepare a schedule, a table to show this distribution. And then we will be recording the journal entry to distribute this net income among the both partners. So let's start with the schedule. Let's make the table. Here is the schedule for the division of net income, how we divide the net income among the partners. So division of net income, same like income statement we're going to write here for the year ended December 31st, 2017. The format is firstly mention net income. Net income they gave us in the question $22,000. Now we are going to divide this net income. So how we divide? We will be paying the salary allowance first, then we will be paying the interest allowance, and then the remaining money we will distribute equally among the partners. So the first column is having the description, what we are doing in each step. Second column has first honor information, Sarah King. The second column has second honor information, Ray. And the third column is total column. Firstly, salary allowances. In the question, they clearly said that for King, salary allowance is 8,400 and for Lee, salary allowance is 6,000. So let's record it. Salary allowance 8,400 for Sarah King and for Lee it's 6,000. So total salary allowance is 14,400. Then second thing is we have to pay them interest on their opening capital balances 10%. Opening capital balance for King is 28,000. 10% of 28,000 is 2,800. Opening capital balance for Lee is 24,000. 10% of 24,000 is 2,400. So let's pay the interest. So interest allowance for the partners' capital balances, they calculated for Sarah 28,000 into 10%, so 2,800 interest allowance for Sarah. For Ray, 24,000 was his capital beginning balance, 10%, so that is 2,400. So together, how much interest was paid to both of them? 2,800 for Sarah plus 2,400 for Ray. So together it is 5,200. So how much total salary and the interest for each partner? Sarah got salary of 8,400 and she got interest of 2,800. So together she charged the partnership 11,200 for salary and interest. Ray's salary was 6,000, but he also charged 2,400 for interest. So together his salary and interest is 8,400. So total salary and interest expense for both partners is 11,200 plus 8,400. Together this is 19,600. What was total income? 22,000. Out of 22,000, 19,600 is already taken up, right? So what is remaining income? Remaining income is 2,400. How come? Opening income was 22,000, but 19,600 is gone because of the payment of the salary allowance and interest allowance. So remaining is 2,400. They said divide is equally. So divide equally means both of the owners are going to take 50%, 50%. So 50% of 2,400 is 1,200. So both of them, they will be taking net income of 1,200. So in the total column, I'm going to put 2,400. So out of total net income of 22,000, how much Sarah took? She took 11,200 plus 1,200. So 12,400 Sarah has taken. 9,600 Ray has taken. And this is how the total income of 22,000 is distributed among the both owners. Let's record the journal entry. So what was the income? Income was 22,000. So income summary account will close, we will debit it, and the capital account of both partners will increase. So income summary gets debit. Sarah King's capital is 12,400, Ray Lee capital 9,600. Now another case. What if the net income is not 22,000? In the previous case, it was 22,000. They say, what if it is not 22,000, it is 18,000? Then what will happen? The same way, salaries and interest, they are going to be calculated. just like this table. So first part, you're going to do exactly the same: salary allowance, interest allowance, and then total salaries and interest. So second table, I'm starting from here: total salaries and interest, Sarah and Ray, and total was 19,600. Now, this is 19,600 is already distributed, but what was the income? Income was only 18,000. So we have a loss now, right? So it is known as remaining deficiency. I cannot say it's a loss because business has net income of 18,000, but I can say it is remaining deficiency, means we have to distribute more, which is 19,600, but we have less profit, 18,000. So how much deficiency? Take a difference, that is 1,600. So this deficiency should also be shared equally among the both partners, right? So what is deficiency? 1,600. So each partner is going to cover 800, 800. So Sarah is receiving 11,200, but she has to absorb the deficiency of 800. So 800 out of this total receipt. So 10,400 will be total taken profit from Sarah. And Ray, the total salary and interest is 8,400, but he has to adjust the loss of 800. So his total take up is going to be 7,600. So in other words, I can say out of total income of 18,000, 10,400 is taken by Sarah and 7,600 is taken by Lee. Okay, now how the capital account of partners looks like at the end of the year. We have their opening. This is now another statement for the partnership, that is partners capital balances. So look here. In the question, they told us opening balance for King was 28 and Lee was 24,000. So remember, partners capital account is increases if the partners do additional investments during the year. Maybe one of them brings more assets. So because of that, their capital will increase. Their capital also increases because of the net income, but their capital decreases when the partners do the drawings from the business. Also, if the business have losses, their capital decreases. So if you see here in this example, which was the normal case, Sarah's opening balance was 28,000. For example, this is an hypothetical figure we are taking. For example, she has an additional investment of 2,000, and net income, we know, we just did the distribution here. Sarah has taken 12,400 net income. So net income is going to increase her capital. So all of them, when I add, her total capital is 42,400. In the question, if they tell you that Sarah also did drawing of 7,000, so her ending capital balance will be 35,400. So I'm going to decrease the drawings, deduct the drawings from the total add up capital. Ray has a 24,000 opening balance. She doesn't make any investment during the year, but her net income receipt, can you see here how much she took? She took 9,600. So it is going to increase her capital. So how much? 33,600. If she has drawings, deduct that drawings out of this capital balance. If she doesn't, that's fine. Also, don't forget to make the total column to show the overall performance picture. After preparing the capital balances, we also prepare the partnership financial statement, which is a balance sheet, because capital accounts, capital balances are reflected in the balance sheet. So all the assets and liabilities we will put, and this is how the capital part of the partnership account will look like. Owner's equity, Sarah's capital, Ray's capital. We just calculated the ending balances for them. So I'm going to report them over here. So total owner's equity is going to be 35,400 plus 28,600. Total is 64,000. And then we have to add them into the total liability section. So this is it for the coverage for this recording. Inshallah, in the next recording, which I will be uploading soon, I will be discussing learning objective number 3, which is how do we treat the liquidation of the partnership? Means when we close the partnership contract, how do we handle the things? I hope you understood these two learning objectives. Please comment and subscribe to the channel if you want to listen or you want to get the notification for the upcoming videos. Take care. Bye.